Money explained. 10 concepts you actually need to know. Taxes. Let's start with the thing everyone loves to hate. You get a job, you work your first week, and you're mentally spending that paycheck before it even lands. Then it lands. And it's smaller. Way smaller than the number you agreed to. Where did it go? Federal tax. State tax. Social Security. Medicare. For little line items quietly picking your pocket before you even see the money. Here's the reframe. Taxes are basically a subscription fee for living in a functioning country. That subscription pays for roads, schools, firefighters, the people who inspect your food so it doesn't kill you, and yes, a whole lot of stuff you'll never personally use. Income tax hits what you earn. Sales tax hits what you spend. Capital gains tax hits money your investments made while you did absolutely nothing. Social Security is basically the government saying, "We don't trust you to save for retirement, so we're doing it for you, whether you like it or not." Medicare is the same idea, but for healthcare once you're older. And then, there's filing taxes, the part where the government already knows what you owe, but makes you do the math yourself anyway, like a pop quiz with real financial consequences. Get it wrong, and you're not failing a class. You're getting a letter you really don't want to open. Banks. You hand your money to a bank like you're handing a valuable item to a security guard. In your head, it goes into a vault and just sits there, waiting for you. That is not what happens. Banks are less like a vault and more like a matchmaking service for money. You deposit $1,000, and within moments, a chunk of that is already out the door, loaned to somebody buying a car or a house. This is called fractional reserve banking. Banks only keep a small slice of deposits on hand because, statistically, everyone isn't going to show up on the same day demanding their full balance back. Usually that bet pays off. Except during moments in history when it very much didn't, and the whole system nearly buckled. So why give banks your money at all? Convenience, mostly. Tapping a card beats carrying cash everywhere. Some interest, even if it's small. And safety, in the US, deposits are insured up to $250,000, meaning the government has your back even if the bank itself stumbles. Interest. Borrow money, and you'll pay back more than you borrowed. That extra amount is interest, essentially a rental fee for using someone else's cash. There are two flavors. Simple interest is a flat charge, no surprises. Compound interest is the one that sneaks up on you, because now your debt is generating its own debt. Miss a few payments on a high-interest credit card, and that innocent $15 lunch can somehow balloon into a $60 problem a year later. But flip the script, and compound interest becomes the best financial ally you'll ever have. Put money into investments earning a steady return, and it doesn't just grow, it starts multiplying on itself. Slowly, then suddenly. That's the entire secret behind almost every boring millionaire story you've ever heard. Not a genius stock pick, just time and patience. The lesson is simple. When interest works against you, pay it off fast. When it works for you, leave it alone and let it snowball. Inflation. You go to buy your usual snack, and the price has quietly crept up again. Nothing dramatic happened overnight. No headline event, no single villain. Just more expensive than last month. That's inflation. Your money slowly losing purchasing power over time. The bill in your wallet still says the same number, but it buys a little less than it used to. What causes it? Sometimes there's simply more money floating around than there are things to buy, so prices get bid upward. Sometimes it's supply chains hitting a snag, making goods more expensive to produce in the first place. And sometimes it's pure psychology. If everyone expects prices to rise, they rush to buy now, which pushes prices up faster, which becomes a self-fulfilling loop. A little inflation each year is actually healthy. It means the economy is moving. But when it spikes hard, paychecks stop stretching as far, and savings quietly shrink in real value. To fight it, governments and central banks raise interest rates, making borrowing more expensive, which slows down spending and cools things off. Recessions. A recession is what happens when the economy shrinks for a sustained stretch, typically defined as at least 2 quarters in a row. One moment, things feel stable. The next, layoffs are in the news, and everyone's suddenly tightening their belts. Think of the whole economy like a long house party. Early on, everyone's spending freely. Businesses are hiring. Confidence is high. Eventually, though, the music slows down. Someone checks their savings account and realizes the good times were partly borrowed against the future. Spending pulls back. Companies cut costs. People start saving instead of splurging. What triggers it can vary. Interest rates climbing too high, a global shock like a pandemic or conflict, or just the natural boom and bust rhythm economies tend to follow. The good news: recessions end. Central banks lower rates. Governments sometimes step in with support. And slowly, spending picks back up, though usually not without leaving a mark. Credit scores. Somewhere out there, a number between roughly 300 and 850 is quietly deciding whether you get approved for an apartment, a car loan, or a decent interest rate, or whether you get slapped with a rate that makes your eyes water. That number is your credit score, and it isn't really measuring how rich you are. It's measuring how trustworthy you look to a lender. Will you pay them back on time? It's built from a handful of ingredients: your payment history, how much of your available credit you're actually using, how long you've had credit accounts open, the mix of credit types you carry, and how many new credit applications you've made recently. Miss payments, and the number drops. Pay consistently and on time, and it climbs. Here's the twist though: you can have zero debt and still have a mediocre score, simply because you don't have enough credit history for lenders to judge you by. It's less about being financially responsible in some abstract sense, and more about proving on paper that you follow through on what you owe. Currency. Here's the strange part: nobody really sits you down and explains. Money, on its own, isn't actually worth anything. A dollar bill is just paper with ink on it. A coin is just metal. The only reason it works is because a huge number of people have collectively agreed to believe it works. That belief is what lets you trade a piece of paper for a sandwich, a car, or a house. In theory, there's no real difference in legitimacy between a dollar and a digital currency like Bitcoin. Both only have value because enough people agree they do. Governments print physical currency, central banks manage the supply, and everyday people move it around in exchange for goods and services. Print too much, and you get inflation. Restrict it too tightly, and everyday transactions get harder for everyone. Currency, at its core, is a shared story that society has decided to keep telling: investing. Once you understand inflation is quietly eating your money, investing becomes the obvious countermove. Instead of your dollars sitting still and slowly losing value, you put them to work so they can grow. There are a few common ways in. Stocks give you a small ownership stake in a company. If it grows, your slice grows with it. Bonds are essentially you lending money to a government or business in exchange for interest payments. Funds bundle a mix of stocks and bonds together, so you're not betting everything on one company. Real estate means owning property, often with someone else's rent payments helping pay it off over time. None of this guarantees a win. Markets rise and fall, and there's real risk involved. But historically, the biggest danger isn't losing money in the market. It's never entering the market at all and watching inflation erode your savings year after year while you wait for the right moment that never quite arrives. Value. Pick up an ordinary rock. Worthless, right? Now imagine that same rock is gold. Suddenly people want it, trade for it, fight wars over it. Nothing about gold makes it inherently more useful than a regular rock. It's rare, and humans have collectively decided rarity plus shine equals worth. This is the entire foundation of getting paid well, creating value that other people are willing to pay for. Someone builds a phone millions of people find genuinely useful, and suddenly they're worth billions. A surgeon spends over a decade mastering a skill that literally saves lives, and that skill commands a high price. It's also why two nearly identical handbags, one from a mall brand, one from a luxury label, can carry wildly different price tags. If enough people believe something is more valuable, in practice, it becomes more valuable: time. Last one, and arguably the most underrated: time. Everyone starts with a decent supply of it, though nobody knows exactly how much they've got left. Most people trade time for money directly, an hour of work for an hour of pay. But the people who build serious wealth usually figure out how to make their hours count for more, often by letting money work on their behalf instead of just their labor. Nowhere does time matter more than in investing. It's not really about picking the perfect stock or getting lucky with timing. It's about starting early and letting compound growth quietly do its work across decades, not days. That's the real reason regular people with average salaries manage to retire comfortably, not because they beat some secret system, but because they let time and consistency do the heavy lifting for them. And that's the honest version of how money actually works.